In 2009, after the most dramatic housing market collapse in modern American history, the median home price in the United States fell to what today sounds almost unreal, roughly $280,000. At the time, people said the bubble had popped, the excess had been washed out, and housing had finally returned to something resembling normal. But here's the problem. It never did. Since that collapse, home prices haven't just recovered, they've more than doubled. And by 2024, the median U.S. home price officially hit $420,000, the highest level ever recorded. Over that same period, real wages have remained essentially flat year after year. The result is that we now have the worst housing affordability in America since 1984. Even worse than at the peak of the 2006 housing bubble, right before everything fell apart. Today, in over 99% of U.S. counties, the average home is officially unaffordable for the median worker. In the mid-1980s, a typical first-time buyer needed about 5 years to save a 20% down payment. Today, that number is 13.5 years, the longest timeline ever recorded. And just since 2020, the average monthly mortgage payment has increased by more than 110%. And this is the key point most people are missing. This is not a collapse of home prices. This is a collapse of access. For the first time in U.S. history, a majority of adults under 40 believe they will never own a home. And no one wants to say this out loud, but a society where most people will never own property, never have a real stake in the future, is not a stable society. When people don't own anything, they don't feel invested in anything, because they aren't. And when people stop feeling invested, they either disengage or they burn the system down. This isn't a housing bubble you can wait to pop and then buy the dip. This is a financial chokehold created by money printing, policy failure, generational incentives, and quiet corporate consolidation. And it's already causing damage, just not in the way most people expect. In many ways, this situation is worse than 2008. But for those who understand what's happening, there are still ways to navigate this system, even if we can't save everyone. In this video, we're going to break it down in 3 parts. Part 1. What actually happened and how housing killed the American dream? Part 2. Who's responsible for this mess? And Part 3. What you can still do as an individual to avoid getting crushed by it. So let's start with Part 1. What the hell happened? Part 1. What went wrong with housing? How housing killed the American dream. For more than a century, the path to the American middle class was remarkably simple. You went to school, you got a job, you bought a house, and over time, that house became the foundation of your financial security. As long as you showed up, worked hard, and didn't completely blow it, your life got better year after year. And if you passed that house, or at least some equity, down to your kids, odds were they'd be better off than you were. That upward trajectory wasn't an accident. It was built directly into the structure of the economy. Real wages were rising. Debt levels were manageable. Housing supply roughly kept up with population growth. And the United States benefited enormously from its position as the world's manufacturing hub after World War II. But somewhere along the way, that system broke. Since the 1970s, home construction in the U.S. has fallen by nearly 40%, even as the country added over 130 million people. Single-family housing construction declined so severely that the U.S. is now short an estimated 3.2 million homes, and that deficit continues to grow every single year. At the same time, we now have the fewest homes for sale per capita in recorded American history. In the 1970s and 80s, your parents typically bought a home for about 2 to 3 times their annual income. Today, for most young buyers, that number is double that, putting homeownership completely out of reach for all but the wealthiest households. The formula that built the middle class, get a job, buy a house, build equity, didn't just stop working, it died. Most people still believe the housing crisis is simply the natural outcome of supply and demand. That prices went up because more people want homes than there are homes available. But that explanation is incomplete. What we're dealing with today isn't a market accident. It's the result of decades of policy decisions, incentives, and political cowardice that slowly and then suddenly turned housing into a scarcity machine. To understand how the dream collapsed, you have to understand the sequence, the era of cheap money, the obsession with housing as an investment, zoning laws that choked off new supply, globalization that stalled wages, and finally, corporate consolidation that finished the job. Once those forces combined, the outcome became inevitable. Housing stopped being primarily a place to live. It became a financial instrument. And once that happened, the game changed forever. Because when housing becomes an investment instead of a utility, every incentive shifts toward making it scarcer, more expensive, and harder to access, especially for anyone who isn't already inside the system. And that brings us to the deeper root of the problem. To understand why housing became unaffordable, you first have to understand money itself, which means we need to talk about cheap money, inflation, and how we ended up here in the first place. Cheap money, money printing, and why everything broke. For most of modern American history, money was anchored to something real. For decades, the dollar was tied, directly or indirectly, onto gold. That tether imposed discipline. It limited how much money could be created, how much debt could be accumulated, and how far prices could drift from reality. But that restraint didn't last. In 1971, the United States officially severed the final link between the dollar and gold. And in that moment, Pandora's box was opened. From then on, money could be created at will. At first, the effects weren't obvious. Printing money feels painless in the short term. It smooths over recessions. It delays hard choices. It gives politicians a way to promise benefits without raising taxes or cutting spending. But over time, it changes everything. As more money enters the system, each existing dollar buys less. That's inflation, and inflation doesn't hit everyone equally. It punishes savers, it punishes wage earners, and it rewards people who own assets. For a while, this dynamic stayed mostly in the background. But after the dot-com bubble burst in the early 2000s, the Federal Reserve leaned hard into cheap money. Interest rates were slashed, credit became abundant, debt exploded, and that cheap money didn't flow evenly through the economy. It flowed into assets, stocks went up, bonds went up, and most importantly, housing went up. By the mid-2000s, this had inflated a massive housing bubble. When it finally collapsed in 2008, the damage was catastrophic. Millions lost their homes. Banks failed. The financial system nearly collapsed. And in response, the government did what it now always does. It printed even more money. Interest rates were pushed to near zero and stayed there for over a decade. The goal was to stabilize the system, and in the short term, it worked. But the long-term consequences were devastating. When interest rates stay artificially low for years, borrowing becomes incredibly cheap. Asset prices soar, and anyone who already owns assets sees their wealth multiply without having to do anything. Then came COVID. Trillions of dollars were injected into the economy almost overnight. Money printing went into overdrive. And as always, prices followed, not just for homes, but for everything. Groceries, rent, energy, healthcare. Inflation began eroding savings at a pace most Americans had never experienced in their lifetimes. Here's the brutal reality. To keep up with inflation, you need one of two things. Either your income needs to rise at least as fast as prices, or you need to own assets that rise faster than inflation. But globalization makes the first option nearly impossible. My homes stopped getting built. At this point, a lot of people assume the housing crisis is simply the result of too many people chasing too few homes. And while that's technically true, it completely misses the more uncomfortable question: why are there so few homes in the first place? The United States didn't suddenly forget how to build. Builders didn't lose the ability to pour concrete or frame houses. What actually happened is that housing supply was intentionally restricted over decades through policy, regulation, and incentives that rewarded scarcity. Since the 1970s, home construction has fallen by roughly 39%, even as the population grew by more than 130 million people. Single-family housing construction declined so severely that the U.S. is now short an estimated 3.2 million homes, and that gap keeps widening every year. At the same time, we now have the fewest homes for sale per capita in recorded American history. This didn't happen by accident. It happened because once people realized their homes weren't just places to live, but vehicles for storing and growing wealth, their behavior changed. Homeowners began voting for anything that would push prices higher. Zoning restrictions, density limits, lengthy permit processes, height caps, parking minimums, neighborhood opposition to new construction, all of it slowed or outright blocked new housing from being built. And none of this was malicious. It was simple self-interest. When supply is restricted, prices rise. For existing homeowners, that's fantastic. Their net worth goes up without lifting a finger. But the consequences are predictable. The fewer homes you allow to be built, the more expensive the existing homes become, and the next generation slowly gets priced out. Over time, housing stops functioning like shelter and starts functioning like a scarce commodity. By the time COVID hit, the damage was already done. The country had endured more than a decade of cheap money, artificially constrained housing supply, population growth, immigration, and then on top of that, a massive influx of corporate capital. Institutional investors entered the single-family housing market with billions of dollars, buying homes that regular families never even saw listed. Firms like BlackRock-backed operators and large private equity funds weren't buying one or two houses. They were buying entire neighborhoods. They weren't looking for places to raise kids. They were looking for yield, inflation protection, and long-term appreciation. When you combine wage stagnation, inflation, restricted supply, and competition from deep-pocketed corporations for an essential resource, the outcome is inevitable. Prices don't correct. They detach. And that's why this moment feels so strange. On paper, housing looks strong. Prices are high. Equity is booming. But for younger generations, it feels like a collapse because access has been removed entirely. This isn't a market overheating. It's a system functioning exactly as its incentives were designed to produce. And once you see that, the next question becomes unavoidable. If this wasn't an accident, then who actually benefits from it and who is responsible for locking everyone else out? Part 2, Who Broke It? This is why it's worse than 2008. In 2008, the housing market collapsed because prices ran too far ahead of reality. Credit was loose, speculation was rampant, and when the bubble popped, prices fell, inventory flooded the market, and eventually housing became affordable again for a new wave of buyers. It was painful, but it reset the system. What we're dealing with now is fundamentally different. This time, prices aren't collapsing. They're locking people out, and that distinction matters more than most people realize. Today, boomers are sitting on roughly $12 trillion in home equity, much of it locked behind sub-3% mortgages that they have absolutely no incentive to ever give up. When interest rates rose, instead of freeing up supply, the market froze. Homeowners didn't sell. They stayed put. Inventory vanished. At the same time, institutional investors quietly accumulated massive amounts of housing stock. Over $60 billion has been spent by large firms buying single-family homes that regular buyers never had a chance to compete for. For the first time in American history, the majority of adults under 40 believe they will never own a home. That belief alone has enormous consequences. Home ownership isn't just a financial milestone. It's a psychological one. It creates buy-in. It gives people a reason to believe the system works for them. When that disappears, social stability starts to crack. A society where most people don't own anything is a society where people stop feeling invested in the future. And when people don't feel invested, they disengage, they radicalize, or they burn it all down. This is why high prices aren't always a sign of a healthy market. Sometimes they're a signal that the system is malfunctioning exactly as designed. What we're seeing now is the convergence of cheap money, structural wage stagnation, supply constraints, and concentrated ownership into a single crisis, a rogue wave of unaffordability. And it's not fading. It's accelerating. The government is still running massive deficits. Money is still being printed. Inflation continues to erode purchasing power. And the very asset that would normally protect people from that inflation is increasingly inaccessible to the average American. So we end up in this bizarre situation where housing is booming on paper, but collapsing in lived reality. For asset owners, life is good. Equity is up. Net worth is rising. But for renters and young families, it's a bloodbath. This is not a temporary imbalance that corrects itself in the next cycle. This is a structural break. And once opportunity collapses, it doesn't come back on its own, which leads to the uncomfortable question that almost everyone avoids. If this outcome wasn't random, then who exactly is responsible for creating it? Who's to blame? Politicians. If you're looking for a single group that deserves the most scrutiny in this crisis, it starts with politicians. Not because they're uniquely evil, but because their incentives are uniquely destructive. To understand politicians, you have to understand one immutable rule of politics. They will do whatever is necessary to gain and retain power. For decades, at the local, state, and federal level, politicians made decisions that directly restricted housing supply because that's what their voters wanted. Homeowners vote at much higher rates than renters, and restricting supply makes home prices go up. Higher prices make existing homeowners feel wealthier, and politicians get reelected. Local zoning boards made it nearly impossible to build anything other than single-family homes on large lots. Neighborhood groups fought density, fought multifamily housing, fought height increases, fought any development that would add meaningful supply. These decisions were framed as protecting neighborhood character or quality of life. But the real outcome was always the same: scarcity. And scarcity drives prices higher. Politicians understood this perfectly. They also understood that telling voters the truth, that prices might need to fall, that budgets need to be balanced, or that entitlements need to be cut, is a fast way to lose an election. So instead, they promise free stuff. And free stuff is never free. It gets paid for with deficits, debt, and money printing. Every time politicians chose the easy path over the responsible one, they pushed housing a little further out of reach. Over time, those choices stacked. And once the incentives hardened, the outcome became unavoidable. Structural scarcity was baked into the system. Politicians didn't wake up one day and decide to destroy housing affordability, but by protecting prices and suppressing supply, that is exactly what they did. And now those decisions are coming due. The irony is that we already have proof that this doesn't have to happen. In places where housing supply has been allowed to respond to demand, where builders are allowed to build and the market is allowed to function, prices have remained far more stable. Houston is a perfect example. While prices across much of the country have skyrocketed, Houston's relative affordability shows what happens when zoning is flexible and supply is allowed to expand. But examples like that are politically inconvenient. Scarcity benefits incumbents, and so the system keeps producing the same result. Which brings us to the second group that benefited enormously from these policies, even if they never intended the consequences. The generation that bought in before the door slammed shut. The second villain: boomers. The second group in the blame stack is the generation that benefited the most from the system as it was being built: the baby boomers. This part is uncomfortable, and it needs to be handled carefully. Boomers are not bad people. For most of you watching, they're your parents or your grandparents. They worked hard, raised families, and did what the system rewarded them for doing. But incentives matter more than intentions. And the incentives boomers responded to helped shape the housing market we have today. Boomers bought their homes when prices were low, wages were rising, mortgages were affordable, and the government was still relatively fiscally responsible. Then, over decades, they voted for policies that protected and inflated the value of their largest asset. Zoning restrictions, limits on density, resistance to new construction, all of it helped ensure their home values kept rising. Again, not because they were malicious, but because they were rationally protecting their own financial security. Then came a series of extraordinary events: the dot-com crash, the 2008 financial crisis, and later COVID. Each time, the Federal Reserve responded with lower rates and more money printing. And each time, asset owners benefited the most. Boomers were able to refinance into historically low mortgage rates, locking in sub-3% loans that they now have zero incentive to ever give up. As rates rose, younger buyers got squeezed out, but boomers stayed put. Inventory didn't turn over. It froze. And because such a large share of the housing stock is now trapped behind these ultra-low mortgages, the market can't reset the way it did in previous cycles. There's also the inheritance cliff. A massive portion of U.S. housing is now owned by people over 65, and much of it will eventually be passed down to their children. But those children are overwhelmingly already in the upper half of the wealth distribution. That means the next wave of home ownership will disproportionately benefit people who were already advantaged, while everyone else falls further behind. Wealth calcifies, mobility stalls, and the system starts to resemble a caste structure rather than a meritocracy. It's important to be clear about one thing. This didn't happen because boomers are greedy or evil. It happened because they optimized for safety and prosperity in a system that rewarded exactly that behavior. But in doing so, they unintentionally helped lock younger generations out of the very mechanism that created their own wealth. And once that mechanism is closed, reopening it becomes politically and economically painful. Which brings us to the third and final group in this stack, the one that took advantage of the system after it was already broken and turned it into a machine. Part 3, What Now? The rules of the game now. At this stage, the most dangerous thing you can do is pretend the system still works the way it used to. It doesn't. The old rules are gone. For most of the 20th century, you could rely on wages to carry you forward. You could save your way to stability. You could work hard, avoid debt, and slowly build a better life. That world no longer exists. Today, if you don't own assets, you are moving backward in real terms, even if your paycheck is going up. Inflation quietly eats purchasing power every year, and wages simply don't keep up for the majority of people. This creates a brutal reality. The game is no longer about income. It's about ownership. If you own assets, inflation works for you. If you don't, it works against you. And housing sits at the center of that divide. Rent is not a temporary inconvenience anymore. For millions of Americans, it's a permanent condition. And rent doesn't build equity. It builds someone else's balance sheet. Every month you pay rent, you're reinforcing the system that locked you out in the first place. This is why so many people feel like they're running on a treadmill that keeps speeding up. They're doing everything they were told to do. They got educated, they got jobs, they avoided reckless spending, and yet they're further away from stability than their parents were at the same age. That disconnect breeds resentment, anxiety, and hopelessness. And those emotions aren't irrational. They're a rational response to a system that changed the rules without telling anyone. The harsh truth is that waiting for housing to become affordable again is not a strategy. Hoping for a crash that resets the market is not a plan. Even if prices fall, supply constraints, institutional ownership, and inflation will limit how far they can actually come down. The system is designed to protect asset values. That means the burden of adjustment falls on people who don't own any. So the question stops being, when will this fix itself? The real question becomes, how do you operate inside a system that is fundamentally tilted against you? Because whether you like it or not, you're already playing this game. And not playing deliberately is the same thing as losing by default. Which brings us to the final part of the story. If housing is broken and wages aren't enough, what, if anything, can an individual actually do? How to survive a broken system. There's no clean ending to this story because there's no clean solution to the housing crisis. Anyone promising an easy fix is lying to you. The system didn't break overnight, and it won't be repaired quickly if it ever is. But that doesn't mean individuals are powerless. It means you have to stop playing by outdated rules. The first step is understanding that the goal is no longer to wait for fairness. It's to reduce your exposure to the parts of the system that are working against you and increase your exposure to the parts that benefit from inflation. That means prioritizing ownership in whatever form is realistically accessible to you. For some people, that may still be home ownership, but for many it won't be, at least not right away. Ownership can also mean equities, businesses, skills that compound, or assets that scale beyond your time. The mistake is believing that hard work alone is enough. In an inflationary system, effort without ownership slowly loses ground. The second step is flexibility. Geographic mobility matters more than it used to. Some markets are simply broken beyond repair. Others still allow supply to respond to demand. Chasing status cities while ignoring economics is one of the fastest ways to lock yourself into permanent financial stress. The third step is psychological. You have to let go of the idea that renting is a personal failure or that home ownership is a moral achievement. Those narratives were created in a different economic era. Today, the real risk isn't renting. It's becoming emotionally attached to a version of success that no longer exists. Finally, and most importantly, understand this. Systems like this don't collapse all at once. They grind, slowly, unevenly. For some people, they work incredibly well. For others, they feel impossible. Your job isn't to fix the system. Your job is to see it clearly enough to avoid being crushed by it. Because clarity is leverage, and leverage is survival. The American dream didn't disappear. It changed shape. And the people who adapt to that reality will be the ones who make it through what comes next. Not by hoping, not by waiting, but by playing the game as it actually exists.